virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, TFW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific date or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, there we go. Now, what the hell is going on here? Participant. Change role to host. All control. No. Cancel. I'm not the host. This guy Wayne is the host. What happened to you, Wayne? Why are you the host? That's why I can. Do you want to become the presenter? Yes. Wayne, who are you? Why are you the hosting this event? I don't know what's going on. For some reason, Wayne was listed as the host. That's why I couldn't share my Wayne on my desktop. Okay. We seem to be okay now, so hang on. All right. There you go. Just got to poke around until you figure out what's wrong with the damn thing. And now I think you should be seeing my boring trading screen. No, let's see. How's that? Chat window popped up. Yay! All right. And we're off. Oh my God, this is so disorganized now because I have to reboot my computer so all my settings are off. All right, let's see what's happening. Look at the Russell go. It's all the way back already. Oh, son of a bitch. All right. Well, so much for the fun little sell-off. Why is it over? Does anyone know what's happening? Let's take a look. See if we can see some news. I didn't hear anything like said suddenly we should be jumping back up. Although Europe closed, you know, realistically, if we think about it, what happened at 11:30? Here, 11:30, Europe closed, and all of a sudden, we're back off to the races. So it's really Europe that was pushing the sell-off. And if we go back and take a look at them, let's see. Pick a window here. Well, that one doesn't need to be there. WSJ. Wall Street Journal. All right, so Europe finished down terribly, 2.5% down. They finished at the lows of the day. I don't see what that makes us bounce from, though. That's crazy. Look at the NASDAQ. The NASDAQ is actually green now. The Dow's only down 100, so it's a big recovery. We're looking very strong. That's the bottom line. And I think the thing is that just, you know, now we're in the hands of the, you know, there's no selling pressure outside the U.S., and we don't have enough selling pressure to keep us down at the moment. We were just discussing in chat, let me see if I can bring that back up. We just had a whole discussion about the Dow and DXD. I don't think this changes anything in China, frankly. We were just discussing about DXD and what to do, and I was saying if we cross back over the 17.7 line here, that we may need to do something about those DXDs before they lose all their values. We only have 10 days left, and we were damn lucky to get this little sell-off. So I think I don't want to push it. That's the problem. We have 100 of those things in the short-term portfolio. I mean, they're already down, way down, but we have to consider that. Also, FXI. Now, let's see if FXI is coming back. That's an interesting thing. So here's the Nikkei. They're back to 17.7. I'm sorry, it's the Dow popped 17.7 already, 17.750. All right, and I think if these guys get over, see this 1180 line, if they get over that, then we really have to give up. We'll watch the Dow over here. But these guys are already green. We're not worried about the Nikkei right now. Let's see if FXI. Not much of a bounce there. So it's not that China's coming back. And if we look at EWJ, That's the Japanese one. It's not that Japan's having a huge comeback, although they can pretty much take back all of today's losses. So these aren't big comebacks. And then what you got to do when something like that happens, you got to look at the news and say, what the hell just happened? The Senate report on CIA tactics. There's nothing in the Wall Street Journal that seems to indicate that something should have turned. So now we'll take a look at Seeking Alpha and see what they have to say for themselves. I like the news in Seeking Alpha. I don't like, market news. That's their best feature to me. All news, and I put on today, because if you don't put on today, it keeps refreshing, which is really annoying. Verizon, income favorites turn green. So the REITs went green. Brandywine, Cavium. Now, we're not looking for anything that happened recently because, in the last hour, we're looking for something that happened earlier that caused a turn. I'm not seeing anything. I'm really not. None of you guys saw anything either, right? Seems like some Fed guy must have said something, but they're supposed to be in a quiet period because they have their meeting next week, so they're supposed to not be talking right now. Corning, nothing. It's going all the way back to 10 o'clock now. Hilsenrath, now when the Fed doesn't speak, Hilsenrath speaks for the Fed, basically. He's the Wall Street Journal guy. So what did he say at 10 o'clock? And we were still going down here. The considerable time language could be gone next week from the Fed. Fed considering dropping it, and that means they might raise rates. I don't see why that would, that doesn't make any sense. I'm stumped. Euro meltdown, they're all buying US. I don't know, Jim, because if that was true, they would have been buying it during our session. Look, in absence of anything that I see here, I saw Apple pop nicely. Apple went from 109 back to 113. So 4% move. That's 109 to 113 is like a 4% move in Apple. That's huge. That adds 1% to the NASDAQ. So there you go. That's how you erase the drop in the NASDAQ, by popping Apple $4. Other than that, though, I'm not really seeing any giant recoveries in the other stocks. I don't see anything really to indicate what would have happened. The dollar is still down at 88.84. Oil, 63.30. Nothing. I don't get it. All right. So basically, I'm very skeptical about this move. I think it may be just that our volume dropped to the point where people were able to manipulate the markets and shove them back up. I don't think there's anything to this move, and I'm kind of not really into reacting to it. In fact, frankly, I think this might be a nice little spot to play short on the Russell. Not with the Dow over 17,750, but if the Dow comes back down, or you can go short on the Dow below 17,750. Here you got 2055 here. So you have let's call these lines things we should watch. So 2055 on the S&P. Let's find the NASDAQ and see what it looks like. We know the NASDAQ is pushed by Apple, so now the question is Apple going to hold their bounce to 113? So here's the NASDAQ, which came up to the back to the middle line here. Nobody else is at the middle line. Oh, I'm sorry. Yeah, the Russell is over it. So if they stay under, who's overshooting? It's the Russell, as usual, is overshooting. So if I was going to short somebody, I would like to short the Russell at this spot. But I don't have any particular reason to short the Russell other than I think this whole pop is overdone. It just doesn't seem logical that we would have moved like that on no news. So who's pushing the Russell? It's so easy to push. That's the problem. It's small caps. $100 million of buys here and there can move the Russell, and then the other indexes follow the Russell because they think something's up, and they're like, oh, what's going on? Somebody's buying, and then somebody else starts buying stuff, and all of a sudden you got a rally. It's so hard to tell, and you got these volumes are so low right now. If we find Yahoo, I know I have Yahoo somewhere on this machine. Oh, there it is. So that's another thing you can always do. You can always check the volume and look at the SPY. You don't have to remember it. It shows you right there. Normal volume is 121. We had 75 million. That's pretty good for this time of day. So it's only 1 o'clock, so we're only halfway through the day basically. So 75 million is decent volume. We get probably about a third of the day's volume comes in the last half hour. So it's on pace. It's a lot more than we had yesterday. And if we try to look at maybe a short-term chart, I'm not sure we're going to get any volume lines on this thing. Yeah, they're very faint. You see, it's hard to tell. If we go 5 days, I don't know if you guys can even see these lines, but there was good volume here. This was some pretty good volume on the downside compared to the pathetic volume we've had the other days. So the volume's up around this area compared to like way down here for most days. So this is good volume. It's what you want to see when you're getting reversal. So, you know, it's not the kind of thing we'd want to write off, but then let's talk about the bounce issue. Here's your SPY. So let's call this, what is this, 208.50 down to 204 is 450 move down. So a bounce from 450 would be 20% of 45 is 90, so let's call them dollar bounces. So the weak bounce is to here, 205, and a strong bounce is right here to 206. So this is a strong bounce line. If this pops on SPY, we got to take that seriously because you got to take the S&P seriously. No matter how much you think the move is manipulated or something's wrong with it, you have to take a move in the S&P 500 as being the right move. You know, if you're doing any kind of technical following at all, you have to take that for granted. So 206 is the line we'd want to be watching. You can see how it acted as support on the way down. So if it was support on the way down, it's probably going to be resistance on the way up. And then what you want to do, see, if you want to use a 5% rule, that's what you do. You got the 50 line here. You got 4.5. So your bounces of 20% of 4.5 is 0.9. All right. So it's 0.9 here, which is, we'll call it 1, and then you call it 1 again. And you're at 205.90. So this is right where you expect to be on a strong bounce. And we had resistance to the weak bounce. Then it goes over, makes a strong bounce. These are bullish signs. It's not a bearish sign when you have resistance to the weak bounce. It's good consolidation. That means everybody who wants to change their mind, and then boom, you have another level of buyers come in. Go over this line, and you're right back onto a bullish path. All right, so that's what we're going to be watching there, and we'll see if we can get over that 206 on SPY. And what's that going to line up with? So now we know that we're right there on SPY, so that means just what I said before, the 2055 on ES is the line we want to watch. And see how I want to short them, and they're coming down already? But, you know, it's still, you got to have confirmation. So 17,750, 2055, and this line right here. I want to use that line, 4287. And see how that was a good resistance here? See how that was last time I hit that? So what do you got now? You got it hitting it, failing. You can get a whole nother run just like this right after it. All right, and the same thing with the, with the Russell. Look at this. This huge move. It looks like a big rally, right? Then boom, it completely failed. All right, that's what happens. You get these fake pops and then the big drop after it. Fake pop, big drop. So I don't know. I mean, it's so hard in a thinly driven market like this to figure out what's going on, but I'm still very skeptical right now, and especially with China and the way China was and the way Europe finished. There's nothing to be bullish about right now. All right, so what are people saying? My question on CL, Chrissy says, you closed a chart yesterday on CL and said something about 600,000 orders. I didn't understand where you saw that number. Oh, the 600,000 orders, that chart, let me see if I can get back to that. Tuesday. Chrissy is talking about somewhere in this thing, we're going to do a discussion on the NYMEX. Oh, there it is. Okay. All right. So we were talking about, first of all, these are the open positions on the NYMEX. Now, what they're looking at is the front month, and here they had 264,000 open positions. They're talking about these contracts here. They don't match up exactly because they're just on different time frames. But I mean different time frames during the day, like one's delayed or this is the end of the prior day. They're not really consistent. So anyway, but the gist of it is there's 270,000 whatever open contracts in the front month. But what I say is important to look at is don't look at just the front month. You want to add up the front 3 months, and that's where I got my 600,000, Chrissy. Okay, because that tells you the pressure. Because what are these? These are all fake orders. Nobody really wants 276 million. There are 1,000 barrels per contract. Nobody actually wants 276 million barrels of oil delivered to them. All right, we only use in the United States, we only use, 18 million barrels a day. So 276 million barrels is pretty much an entire month's supply. We don't need it. We don't want it. Nobody wants that delivered to them, especially the delivery contracts for the NYMEX go to Cushing, Oklahoma, which is a facility that can handle at most about 50 million barrels in a month. But that would be if it were empty. It's not empty. It's basically full, as is every single other storage facility in America. So they can barely handle, given the, the turnover and daily throughput and whatever, figure in a month they're going to handle about 20 million barrels of new oil coming in a month. So 20 million barrels, that would be 20,000 contracts out of 276,000 contracts are actual orders that will be fulfilled in January. The rest are fake. But not just fake like you buy a call on Apple and you don't really want to buy Apple and you're just buying the call contract. Not fake like that. This is fake like they physically cannot take delivery and they must get out of these contracts before the end of the month. So that's just massively fake. And that's what we look at here. So all these orders are fake, and that means that they've got to roll all 250,000 of these 276,000 contracts have to be rolled by the 20th. Well, not exactly the 20th. What it is, the rule for the contract is 3 business days before the 25th. So I assume, 1, 2, 3, so I assume it's the 22nd of December. They probably have until the 22nd to close out the NYMEX contracts this month. So whatever the 25th is, you go 3 business days before it, and that's the closing date. So depending on the month, like next month, here's the 25th. So 3 business days is 1, 2, 3 is the 21st. But it's always around the 20th. Obviously, it just depends on where the business days fall. Oh, I'm sorry. So next month's tricky because you got Martin Luther King Day too, but I don't think that's going to affect it. This week is Martin Luther King Day week. And that's so Monday's a holiday, it might mess things up. Anyway, back to topic. So basically they have until the 22nd, and today being the 9th means you've got about not even 2 weeks of trading left. So once you get into like the last 10 days of trading, I also count these, because what they have to do is they have to take 250,000 of these contracts representing 250 million barrels of oil, and they have to roll them into the following months. And that's what you'll see. If you track this closely, you will see that eventually all these contracts will become reflected in essentially in the next 4 months going forward. So these guys will raise by the amount, these guys will raise by, this will drop by 250 million, and these will raise. Because in the NYMEX, there's no real penalty and no real cost for rolling your contracts for the next month, other than your original cost that you bought it for. Now, the problem for a lot of these guys, though, is they bought these contracts for $100, and they can't even sell them for 65 right now. They're praying they're able to sell them for a higher price. But so as a rule of thumb, though, it's difficult to roll the contracts when there's 600,000 contracts in the front 3 months. Just a rule of thumb. It's not a definite this or definite that. But that's just where it starts becoming awkward, because they pile up so many contracts that it becomes difficult on a daily basis to roll them and sell them and cancel them. Some get canceled, some get rolled, some actually do get sold. But you run out of suckers after a while, and when you start getting over 600,000 orders, there becomes a lot of pressure. Now, at one point earlier in the year, they had 750,000 open orders, and that's when I was screaming for everyone to short oil. It was so much and so ridiculous that there was no possible way, not necessarily in that particular month, but at some point there's a reckoning. And we had a reckoning, didn't we? We had a huge reckoning, because here we are with oil at 65 bucks down from 105 bucks. So we had the reckoning, and frankly, we're done with all the easy plays on oil. We hit a period in the middle of the year where we had a phenomenally easy trade, where my opinion was back in June, when oil was getting close to $110, that as long as you were willing to stick with the trade, if it went against you, it didn't matter, because as long as you were willing to stick with the trade for a month or 2 months, there was almost no way you could lose. And I said oil is going to go down to 70 or 80 bucks a barrel, and it did. But now it's down to 70 or 80 bucks a barrel, so I no longer have any conviction like that. I have the conviction that it's way too expensive. So now we're probably not going to play oil again, not in any heavy way, unless it gets really, really cheap, in which case we'll start playing it bullish. And really, really cheap, I mean like 50 bucks. It's at 60 now. If it gets to 50, then I could play with conviction and say, you know what, I don't mind rolling and covering and rolling and covering for a year at 50 bucks, because I'm sure something's going to happen at some point to kick it up to 70. So, we already have a poke at it we took in the USOs. We bought some USOs. But on the whole, the point is that when it's really low, I don't mind playing it to go bullish, because eventually it's going to go up. And when it's really high, I don't mind playing it when it's eventually going to go down. But 70, as we discussed in chat all week, frankly. I mean, the last 2 weeks we've been talking about this. 70 is the price oil should be. So if it's within 20% of 70, which is 15 bucks of 70, so as low as 55 and as high as 85, that's just the range. And the worst part of the range to play is the middle of the range. So when oil is near 70, it's no play. It's not in a position where it could go up or down. We have no idea on any given day whether it goes up or down. When oil's down closer to the bottom of the range, down at 55, it gets exciting to go long, because you've got a good chance you'll get back to the top of the range, or at least the middle at 70. All right, so what's the rest of Chrissy's question? She says, I don't see where you saw that number, so I hope we got that straightened out. And you do the 5% rule on CL. You do, but, oil is extremely manipulated, and it's also very, very time sensitive to the month and everything else. There's other factors that you have to really look at. So as far as charting oil, let's see what I need. I need my stock charts. All right, so hang on, let's go. So as far as charting oil goes, we did this too. I'm sorry, we did this yesterday. Didn't we? Yes, we did. I made some beautiful charts. Where were they? Look at that. That's gorgeous. All right. So as far as charting oil goes, we decided actually 75 is our midpoint for oil. And why 75? Well, because 50 was serious support back in the day, back when oil was cheap. 50 was a serious support line. Did a run from 50 to 100. I don't care that it went to 110. That's an overshoot. These are spikes, okay? This thing, now the spike lasted from July until October. Kind of long for a spike. But still, it was manipulated bullshit, and I said it the whole time it was up here. I said every day, I was banging my fist, short oil, short oil, short oil. And it worked for us because we took the shorts, like we were happy to get a short that went from 107 to 102, went back up, we took it again, we took it again. But eventually, my point was that at some point, this was going to collapse because it was all bullshit, and it was all bullshit, and it finally collapsed. And then it came back, and then it collapsed again. Now we have a proper collapse, but this is where it should have been all along, 75 bucks. Okay? So 75 bucks is the real line. Now, we did Fibonacci lines off this, but what's a Fibonacci line? It's essentially the same as a strong bounce, 38%, 38%. That's the 40% strong bounce or weak bounce move or weak retrace move off 75. So here we are down here, and that's strong. We expect that line to offer a bit of support. We overshot it, but we never made it to 62.50. And now I think what's oil this moment is 63.23. So we're not doing very good. We're down here still. And you can see we're really just finishing up this move, and we go here, and we'll probably end up going here, which is what, 60 bucks? Here's the $60 line. But that should hold. And 60, look, we already have our USOs because we were betting it's going to get back to 70. So at 60, we're going to make a stronger play on USO. We're going to add to it. We're going to roll and so on and so forth. And we'll keep doing that. I'll do that again. And then at 50, we'll do it again. Because, frankly, at some point, it's going to turn back up. So just like anything else, when we have a conviction play, we roll, we add more, we roll, we add more, and then we just get in it for the long term. We'll be, we'll be in the 2017, whatever the hell for USO by that time. All right, so you don't recalculate, unless you're day trading, which I guess you are, you don't recalculate, because she's asking, drop from 64 to 62, do you calculate a strong and weak bounce? You can calculate a strong and weak bounce off any consolidation, but you've got to see some kind of consolidation, and that varies on the period you're looking at. So let's go back to the futures now. And how are we doing here? Oh, over, and not over, and right on the line. Interesting. What did I say? Oil, right? CL. So, what is our time frame? That's the question. If you're trading, there's a 5-minute chart, so this means you're day trading. So, if our time frame is here, what's our consolidation? We had consolidation in 65. We fell to 62.50. All right, I'm not going to count this. Certainly I'm not going to count a spike like that. I'm going to go by that line, and I figure 62.50. And you see how you have support right here and support right there. So I'm going to call this a 250 drop. And if your drop is 250, how much is your bounce going to be? Your bounce is going to be 50 cents, right? It's going to be 20% of the 250. So your bounce is from 62.50 to 63 is a weak bounce. And then your next bounce is going to be from 63 to 63.50 is a strong bounce. So your strong bounce line is 63.50. And what's an overshoot of 63.50? Well, the next incremental move is going to be to 64. And what happened? We have a little spike to 64, but it doesn't hold. We have a spike to 64, and it doesn't hold. And on the whole, the 63.50 line, right there, that's your strong bounce. It's generally, obviously, it's up, it's down, whatever. But that's the problem with oil, because it's so heavily manipulated and pushed around, you can't. And not to mention the fact that it also fluctuates with the dollar, all right? So you just have to take that into account. So in general, you have your 5% rule, but it doesn't work as well with something that's manipulated the way oil is. But still, you can see where the guideline works, because you start out with 62.50. Once it clears 63, that's over the weak bounce line. Once it gets to 62.50, that's a strong bounce line. And at the strong bounce line is where you might want to start making some bearish bets. But then what's the halfway point? The halfway point would be 75. 63.75 would be the 50% line. And in fact, see that? 63.75 is that pink line right there. But we knew that. See, this is the thing about the 5% rule. You know that. You know where this pink line is going to be before it drops, because you know how much of a drop you're expecting. You're expecting a 250 drop, all right? Because on our bigger chart that I showed you on this chart, it's right there, 62.50. We knew that line was. We knew that was the line we expected to bounce off of. So before it's drawn, this is where you make your money. Before the line is drawn, you know where your goal is. You know 62.50 is your bottom goal, and that's where you know to go long for a bounce. Then there's either going to be a weak bounce or a strong bounce, and when you get to the strong bounce, you get out, and then you start looking for a way to go short. That's all. That's how it works. You know, there's those kind of guidelines. All right. Jim says, yes, we can. Oil just dropped again, down to 63. And where does that oil chart with open contracts come from, Craig? I have it up in the, damn. Hang on. It's called, because I don't have it on this computer, I have it on my other computer. Futures.tradingcharts.com is the main site. Let me see what happens if I bring that up by itself, because it's got a complicated thing after that. But futures.tradingcharts.com. And if you click on oil and say chart, let's see what happens. Oh, no, sorry. Quote. If you click on light crude oil and hit quote, that's where it brings it up to. Okay, there you go. All right, futures.tradingcharts.com, and then you get it. You're presented with a bunch of commodities, and you can click on oil, and everything's easy after that. And I look at that every day. Speaking of oil, BHI, what's your view on that trade? Oh, absolutely. I don't get it. I feel the way about BHI the way I felt about Yahoo before they had their before the Alibaba thing. I just don't understand how that trade is available to us. It's too good to be true. It just makes no sense that nobody sees it. All right, so let's see where we are. BHI was a top trade alert. I remember that. So let's take a look at our top trades. It was very convenient, right? All you got to do is open up our top trades, and you'll see those. I just sent out a top trade alert this morning. I was just basically we were in chat, and I was reminding people. I was saying, look, here's our Apple trade, which is we're not ready to pull the trigger. Now you can say, oh, geez, we could have almost had it, right? We almost were there, and we could have sold that. But we're not looking for like a tiny dip to sell. If there's a big dip, we'll sell. If there's not a big dip, we never have to worry about it. We're going to make lots of money. Then ABX and SLW obviously are doing very well. I said this earlier. They weren't up so much. ABX is up 6% now. SLW is up 5%. But of course they should be. I mean, why wouldn't they be? Gold and silver are flying up. And I liked FCX too. And FCX is down, but I like them here for a turn. So it was $24.95. Now it's still $24.89. So it's still in the same place. But I just like them as it's a nice little play on FCX. But that wasn't why I'm here. Why am I here? Apple? No, we weren't talking about Apple. Here's the ABX and SLW original trade. Here's USO. USO again. Boy, I like USO. Here's GoPro. No, that wasn't the trade. ABX. What the hell happened to the BHI trade? Man, we pick a lot of trades. Look at this. This is a great service. All right. Unfortunately, I have no idea where BHI is. I know it was a top trade. Oh, maybe it's here. I think it's part of this one. This is just a long one. Oh, yeah, okay. It is. All right. The point of this alert was the BHI trade. That was the one that was highlighted. The rest were just sort of chatty. I felt that it might be a good idea to send this out, but the people who were just top trades got totally confused because I shared too much of the chat. I thought this was like a lot of useful stuff we were talking about, but I'm not going to do that anymore because the top trade people got very confused because they're not used to seeing all of our chat stuff. So the point of the BHI trade, which we did put in one of our portfolios, is, look, Halliburton wants to buy BHI, and they offered like $57 or whatever the hell it is. Or no, not 57, sorry, $75. But the $75 is partly cash and partly stock, and that's how you get $75. Now, the problem is Halliburton, meanwhile, their stock is deteriorating. Let's see if I can make that smaller. Add that tab here. Okay, and what were we going to look at? Stock charts. Okay, so meanwhile, well, the problem is since the trade is only part stock and part cash, and actually mostly stock, Halliburton, look what happened to them. They fell from 50 to 40. So unless the terms of the trade get changed, I think I wrote this up somewhere. You get 19 in cash and 1.12 shares of Halliburton, which was now 50. So that worked out to 75. Now the problem is with Halliburton at 40, unless they change the terms, it only works out to 65. So it's not that Halliburton dropped the offer, it's that the value of the offer dropped from 75 to 65 because they're offering the same 1.12 shares of Halliburton plus $19 in cash. I guess there's a billion shares because there's 19 billion in cash. So you're getting $19 of cash plus 1.12 shares of Halliburton. So if Halliburton's at 40, you're getting $44 worth of Halliburton plus of the stock plus 19 is going to be 63. All right, so figure with the 1.12, figure 65. So let's call it 65. All right, and now where's BHI now? So BHI is at 55. That's quite a bit lower than 65, right? What I like about this deal, though, is if the trade doesn't go through. So first of all, Halliburton's probably going to up the offer, up the cash or something to balance this out because they offered 75. BHI said yes to 75. They did not say yes to 65. So Halliburton is going to have to increase the amount of cash they're putting into this to get it to go through. That's going to piss off their shareholders, so on and so forth. But part of the reason Halliburton put in a ridiculous $3.5 billion breakup fee, and those breakup fees do not go away. They're very, very hard to get out of. BHI is because Halliburton doesn't want their shareholders to vote it out. The guys, the board of Halliburton, the CEO and so on, he puts in a terrible, terrible breakup clause because he doesn't want the shareholders to vote down a change in terms, because that's exactly what happens in these trades. You make an offer, your stock goes down, you have to renegotiate and make a higher offer. He has to say to his Halliburton people now, he's got to say, hey, we're stuck in this trade because if we walk away, we have to give him $3.5 billion anyway. So what's the difference if we give him $3.5 billion more cash instead of blowing the whole trade and getting nothing for the money? See, that's the psychology of these things. I used to do this for a living. So that's what's going on. Now, the interesting thing, keep in mind, Baker Hughes is only a $24 billion company, even at 56, which is a nice bump in their PE. They have a 19 PE. They make good money. There's nothing wrong with this company. Of course, it's a very bad time in the industry. But this is a company that's dropping $1 billion to the bottom line for a year now. But think about this. If they have a $3.5 billion breakup fee and they only make $1 billion a year, what does a breakup fee do for their company? It's a 3-year kick. It's as if they make 3 years worth of income in one shot. Or for the next 7 years, it's a 50% boost to their income. How is that going to be bad? They almost would rather have it break. They'd almost rather have the thing fall apart and get $3.5 billion in cash for doing nothing. All right, so this is a quarterly number. Even quarterly, as of last quarter, these guys were making good money. All right, and if we let's take a look at the analyst estimates. Now, they're going to be coming down, and in fact, you can even see what they are 7 days. So the EPS estimates have come down, but not considerably. 90 days ago, they were $5.50. Now they're $4.69. But let's think about that, $4.54 trade. Let's say it goes down to $4. It has to go down to like $2.50 a share before their PE is back to 20. All right, and that's without Halliburton, without any special money, without anything else going on. These guys are absolutely worth $50+ a share. Okay, so now let's get back to our trade. So just so you understand that basic logic of how we're valuing this thing. So these guys are definitely worth $50 a share. So what's our trade? We're selling the $55 puts for $4.50. So we net in for $50.50. That's what we think. There's no way they're worth less than $50. All right. Here's the pop they got. They were trading at $50, even with the oil sell-off. They were down from 75. They sold back off. They popped back to 75. This doesn't show up, but they popped back to 75 on the buyout news. And that's all Halliburton was doing, saying, hey, we'll buy you back out at your high of the year. So Halliburton wasn't going crazy. They said, look, you guys had a solid month of people valuing you at $75, so we're willing to pay you top dollar for 2014 for your entire company. That's what Halliburton's offer was. So from 50, pop back to 75. Seems like a lot for Halliburton to pay, but they know they really want it. Also, of course, Halliburton has a lot of extra value they get because they're going to be able to cut spending and so on and so forth by merging the companies. So there's a lot of good reasons for Halliburton to do this deal. So then I said, so I like that entry just fine. I don't even mind entering at 55 because when they have the cash or the breakup fee, if they, what's our date? If the deal goes through, of course we're going to get called away at 70. There's no question about that. If the deal doesn't go through, then we have $3.5 billion more dollars than we had when they were trading at 50. That's got to be worth $5, guys. All right, so that's what this spread is. So what are we doing? We're selling these. We got the 55 puts for $4.50. We're treating it like free money. We're buying the 2017 57, 50, 70 bull call spread for 6, and that's where we are. Now, this deal is much, much better now. Let's see, with 57, 50, 70. Watch this. You can do much, much better now, BHI, than you could then. 2017. And oh, by the way, why go to 2017? Because first of all, if the deal doesn't go through, we want time to recover. Second of all, if the deal does go through, then all this stuff gets canceled out and we get our cash. You know, the minute the deal finalizes, all these options go away and we get paid off. And what we'll get paid, by the way, though, is we'll have these weird options to give us 1.12 shares of Halliburton plus the cash, but still we're essentially cashed out and we should be able to just get out of the trade at that point for the full price. Where are we then? Oh, 57.50. So the 57.50s, see, this spread is ridiculous. The 57.50s, we'll go by this one's $9 is the last sale, and the 75, was it the 70s? No, 70s, and the 70s are 450. So the net on the spread now is about 450. Actually, it looks like it's 420 there. So the net on the spread is now lower, and the $55 puts are now selling for $8.15. You could almost buy two of these. You could almost buy two of these bull call spreads against the put, or just sell the darn put for $8 if you can, and you have a $4 credit even after you buy the spread. How great is that? And if you get called away, assuming you do the 1x trade, you sell these for $8, you buy the spread for $4.50, you end up with about $4 left almost, and you have a $12.50 upside here, plus you keep the $4 at $16.50 for doing nothing. That's a great trade. That's probably one of my favorite trades of the year. In fact, I probably will talk about this trade, if it's still available, when I'm on TV in 2 weeks, because I have to be on TV in 2 weeks for my trade of the year. So I think this will be one of my alternate trades of the year. It actually might be my trade of the year. It's really good. So, guys. Oh, yeah, I like doing that stuff. I thought the strong bounce negates the short. No. Breaking over a strong bounce negates the short. You expect a strong bounce. A weak bounce is absolutely a bearish signal. Getting to it, first of all, it's in the period also. It's having a weak bounce in the same period. It has to make a V that matches. So the fall has the bounce has to match the time period of the drop. So let's see if we can take a look at that. Oh, out there. It's a trade-up. So what does that mean? Here, the drop took a full day. That means they have one full day to make a strong bounce. If you don't make the strong bounce in one full day, then it's not a good signal, okay? You need to, it only negates it if you go past the strong bounce in the same amount of time or less than you made the weak bounce. So here you go. See this guy? That's a bounce, and that's, I would say by eyeballing that, that's a strong bounce. But here's a strong bounce in a sooner, not in a faster time period, because it's within the time period of the fall. All right? So you have to get over the strong bounce before this time period of 1 day. So you got a 1 day drop here, but I mean pretty much from here. You have a 1 day drop, and if you can't make a strong bounce in 1 day, that's continuing the bearish swing. Your bearish downtrend is continued. And what does that mean? Imagine if you drew a line here, right? One of those, here's your trend line. See that? If that's the top of your trend line is your strong bounce, then you can see it can just keep going down. And then the next one, and if that goes, and if this, by the way, if the strong bounce fails here and you go back here and then you make a weak bounce, what's that telling you? It's telling you you're drawing a very solid trend line going down this way, right? Just as one of those like stair-step patterns. So no, a strong bounce doesn't negate a short. It's breaking over a strong bounce in the time period of the fall that negates the short. So it all depends. You have to get used to the concept. It depends on what time period you're playing. Now, if you look at this one on ES, let's see if we can, there you go. So what's our drop? Our drop is from here to here. And let me, actually, this is easy. So it's 75 to 35 is 40, right? So 16 points above that is going to be 51. So 51 is your strong bounce. So we did go over the strong bounce, and we did it in less time than we fell. And that's what you want to see. You want to see some kind of strong V forming somewhere. That's going to give you a hint that you're going to be doing well. This one totally broke. I mean, this one blew it away. So this one, here's where you broke over. And see, at that point, you can't be bearish. Once you break your strong bounce, which was probably here, I think we said on here, once you break your strong bounce, you should not be bearish at all on this particular thing. Okay, so you want to watch that line, and that tells you get the hell out of your short position at this point. Yes, once you're over that strong bounce. But making the strong bounce, as happened here and here. Now, you're over the strong bounce here, but how long are you over it? If it's only spiking over it and comes back, what's important is where it finishes in the same period. That's what matters. So if I was drawing this line here, it would go down this way and cut to here, which is right about where we said 2050. We talked about that line. So I would go right to here to the 2050 line. And if you imagine this line being solid, I wish I had a line tool that did this, but if you imagine there being a solid line here, if this thing falls below 2050 by the end of the day, all it looks like it did is spiked up briefly and then fell back to the downtrending line. So that's not bullish. Intraday, you just have to make these decisions. You have to say, is that a strong move or a weak move? The Russell, so what is my decision today? I'm ignoring the Russell because it's bullshit. All right? I will pay attention. I'm ignoring the NASDAQ. I'm ignoring the NASDAQ because it's Apple. Apple went up $4, and the NASDAQ went up 1%. Big whoop. Okay? All that's doing is showing me Apple had a recovery. It means nothing about the rest of the index. In fact, yesterday, I forgot to mention that yesterday. Yesterday, the declines on the NASDAQ were like 2-to-1 over the advances, and I bet today is the same. It's just what they're doing is they're pumping up the headline stocks, and they really are very, very good at manipulating the Russell to make it look good. They're very good at manipulating the NASDAQ. Any idiot can manipulate the NASDAQ because it's just Apple. So all you have to do is get a buying thing going in on Apple, and boom, and you can move the NASDAQ any way you want. And then the other indexes are going to follow the NASDAQ. And that's how you get rid of it. That's how you negate a downtrend. So the question, again, it goes back to the same thing. Move the NASDAQ down here. Now, this is a very strong move, but we're ignoring the NASDAQ. What I care about is what the S&P does, what the Dow does, and what the New York Stock Exchange does, but we don't have a thing for that. All right, so Craig says, are you looking to play Nikkei NKD again? Well, we have the continuing play because as we said, our target is 17.3. I think now this bounce, see, the bounce over 17.6, though, that was our stop out, so we are stopped out here. So the answer is yes. Below 17.6, I'd play them again. At 17.8, I would consider playing them again. I'm not too thrilled here. This is kind of in between. I'd like to see where it goes. I do think, though, and by the way, we still have our EWJs, so I'm not taking those off the table yet. But again, it's like I like to play the easy play. So to me, the easy play is shorting these guys at this red line at 183, whatever. You know, that's an easy play. An easy play here would be at this line, 17.9 is an easy play. But here, not too thrilling. If they get over it, it's very dangerous because that can be bullish. But I think the Nikkei down here, although I heard more stimulus talk on Japan again, so that's probably keeping them up for now. And the yen, by the way, the yen fell hard. The yen dropped to where are we? I'm sorry. The yen got stronger, 118 to the dollar. That's a big, big move from 122. Then it now popped back to 119. That's weaker. Higher yen to the dollar is a weaker thing. So it's back to 119. They want to be around 120, but 120 is starting to really hurt the economy over there. So they're getting to fight internally about what should and should not be done. So with the NASDAQ, is the NASDAQ going to continue going up? That's question number one. How does the NASDAQ continue going up? The NASDAQ continues going up if Apple continues going up. Is Apple going to continue going up and becomes a question? All right, it's very easy to get Apple to bounce off a low thing like 110 because there's lots of people who want to buy it. It's 110, and a ton of people come in to buy the thing at that price. So it's very easy to find buyers and to start a rumor or do whatever they did to make it go up. They made it go up, and they found lots of buyers, and people were very excited. Now it's all the way back up to 113.50. The question is, in the longer term, does Apple have what it takes to get to 116 again? And I think not. I think 115 is going to be very tough for them to cross right now in a weak market, and that means the NASDAQ probably doesn't have very much further to go. So another reason. Also, by the way, we have our Treasury auctions going on the next 2 days, the 10-year and the 30-year, 10-year tomorrow, 30-year on Thursday. Probably until tomorrow afternoon. They don't really want to push the market back up too much because they really got to sell these notes at a good price. Because if they get, this will be the last Treasury auction of the year, and they really want to go out with a good, strong sale because that sets the tone for next year's sales. And that's the number one thing the Fed is terrified about and the government is terrified about. Is we're $18 trillion in debt, and we have to make interest payments on $18 trillion in debt. So right now, we're averaging 2% on our debt payment, which is not even 2%. We're probably averaging 1.5%, is my calculator. So let's see. We got 18 trillion, all right, so let's call that trillion, and times 0.015 is 270 billion. That's just to pay the interest on the debt. We need $270 billion a year. That's 10% of all the money the government collects goes to paying the debt, okay? So now, if let's say the rates go up 1 point, okay, and it goes to 2.5 next year. So now we're going to say times 0.025. So a 1% rate increase, and suddenly it's $450 billion just to pay our debt, another $200 billion. Where the hell is $200 billion going to come from in this economy? What programs are they going to cut to get $200 billion more just to pay interest on the debt? That's why the government is absolutely terrified of rates going up. The Fed can't allow it, the government, because who does the Fed really work for? They work for the Treasury Department. The Treasury Department doesn't have $200 billion. They have to do everything they can to manipulate the market to keep rates as low as possible. And it's not just us, it's every country in the world is like us. They're 100% of their GDP in debt. And if the rates start going up, everybody's going to start defaulting on debts or printing money to cover their debts. It's going to be a complete disaster, which is why I'm still very bullish on gold. I'm bullish on inflation. It can't be contained. You can't keep rates. The only way to keep rates artificially this low is to keep printing money. And if they keep printing money, they devalue the money anyway. And if they keep devaluing the money, then people who are lending money for 10 years are going to start saying, hey, this is a scam. I lend you money, and then you print more money, and my money is less valuable. And sure, you pay me back, but you pay me back in crappy, worthless currency. So I demand 2%. I demand 3% for a 10-year note. And if that starts happening, and then that's the thing. On the longer end, they don't borrow as much money, but they borrow a lot of money on the 2-year, 3-year, 5-year notes. And if the short-term rate of inflation starts looking like if those people start complaining and saying, I'm going to take no 1% for 5 years, you're nuts. Because there's no way I'm getting my money's worth. I'm losing money on my 5% notes, on my 5-year notes. And if that starts to become the norm, because right now we're benefiting from the dollar being safer looking than other currencies. But if people start saying, well, you know what, your dollar is safe, but it ain't that safe, and they start asking for more money for the dollars and more money for Deutschmarks and more money for yen, and they start catching on to the scams going on globally, and like it's been said, and I talked about it a couple of weeks ago, it's a Ponzi scheme. That's all it is. And it works until people start saying, I don't want to play anymore. And as soon as people start wanting to take their money out of the game, then the whole thing explodes. And by the way, that's already happened because the Fed bought $4 trillion worth of notes. So the reason the notes are cheap is because the Fed buys them for ridiculously low prices, because the Fed doesn't care if they make money on it or not. The Fed doesn't care if they make money on the notes. That's not what they're in they're not in that business. They get the money for free. They can buy the notes for cheap. They call it a profit no matter what happens. You know, for them, if they make 0.5%, that's fine, because it's 0.5% more than they had. The money didn't cost them anything. All they do is write a check. They don't have to actually have the money. They just write a check. They write a check, they get to buy the bonds. All right, and then they get to declare the interest as profit. They pay the bond money back. It makes no sense, but that's the way it works. So the thing is, if the Fed wasn't buying $4 trillion worth of bonds, and by the way, they didn't stop. When they talk about QE, they kept increasing the amount the Fed is buying. And now they're no longer increasing it, but they're still rolling it over every month when they have these note auctions. And what's also been helping is the amount we're borrowing, because Obama's lowered the debt tremendously. We're down to like $500 billion of debt. So Obama's lowered the debt from $1 trillion to $500 billion. So at the same time that we are borrowing much less money, the Fed is buying much more money. And so now what's happening is essentially we're selling all of our debt to the Fed, and every year just rolls over. So it's not that there's these mysterious foreign buyers who are happy to buy dollars and happy to buy our treasuries. There aren't lots of idiots around who are giving us money for 5 years at 1%. And nobody's doing it in Japan either. It's the same bullshit there. Japan's central bank is doing it there. The ECB is starting to do it in Europe also. Everybody's just buying their own debt with their own checks and making up their own money. And it's all bullshit. And one day it's going to collapse like a giant house of cards. And that day it's going to be and it's not going to be one day, and we'll see it coming, and it'll be kind of obvious as it starts to happen. The same way that the Greece crisis seemed, you see it coming because you saw the rates going there. Like they went from 12 to 13 to 16 to 20%. When you start paying 20% on your bonds, you know there's going to be a problem with the market. So that's in the future is going to happen. The question is when, and we don't know when. But that's the end game of this thing. It just can't last forever. I forgot what the question was, but that's the answer. All right, so FXI is still shortable. What would be your play? The same thing we have now, which is, I forget. What would be your, we cashed out of those FXIs, didn't we? That's right, we did sell half. That was our call earlier, which is a good call. And this is, by the way, this is why you always sell into the initial excitement. So, here you go. Somebody fortunately mentioned, I guess it was Palate, he said we were talking about FXI and what we should do with it. It's, when you get a drop of 5% in one day and your options practically double, we got back to $1.64, I think they were 88 cents when we bought them. You take half off the table. And it goes back to the same thing. Like, don't wait for me to tell you to take half off the table when you have almost 100% profit in a day. That's crazy. So these things are now free. And if they go back to 88 cents, which I doubt they will, but if they go back to 88 cents, then we stop out even on the half that's left, we're still going to be up 50% on the whole trade. Why would you not want to lock that in? It doesn't make sense not to lock that in. It's crazy. So this was a great move. We didn't expect it in one day. We got it in one day. Even if it goes down to here, it's like, well, what do you do? That's freaking lucky. But we take half off the table, and we did that. And so I wouldn't right now know where FXI went. I don't think it went too far. No, it's 40.20 now. So I would not chase it. These things are still $1.53, so that's not bad for the 40 puts. So it's not something I would go chasing, but it's, but that's the way you play these things. We took the trade last week, I think it was, and it paid off today. That's it. When something pays off, take the money. If you can't learn to take the money, you can't learn to be a day trader. When you win, you take the money and go to cash. So FXI is still shortable. It is still shortable. I think it'll go further down, but I wouldn't chase it if you're not already in it. Maybe it'll pop, maybe it won't. I sincerely think it's going to go quite a bit lower than it is now. But again, there's so much stimulus talk and so much artificial crap going on that you can't count on anything. It's just, you got to take those little games when you can. When does the Santa Claus rally begin? Geez, if that wasn't the Santa Claus rally that we just had from, where are we? Traditionally, the Santa Claus rally is Thanksgiving to New Year's. But if that wasn't the Santa Claus rally, going from 1875 to 2075, 10% move on the S&P, I don't know what you're looking for. Okay, you can't, just because you know the word Santa Claus rally, that's not a thing. It isn't. If you look at it historically, it's like, yeah, we tend to have a rally into the end of the year. But this was your rally into the end of the year. Just you already had it. You're not going to get another rally of 10%. That would be insane. I would dump the entire long-term portfolio and just go short if that happened. And we talked about Apple, and like I said, I think Apple 115 is a good price for them for now. They have to show something in earnings to really get over the 120 mark. And I said that when it was here. You know, when it was at 120, I said we're not going to break 120. I was actually surprised we actually hit 120. But that was a logical place for a pullback. And here, and look at Apple. Apple, you know, we were down 60. It's hard to reconcile because of the stupid the changes. But $60 is really your big consolidation on Apple. So 120 is a 100% run on Apple. You're going to have a pullback from a 100% run. I mean, if you don't, there's something wrong. All right, so we go from 60 to 90. There was really no pullback at 90. We had a little consolidation, but no real pullback. We ran all the way up. You know, a little consolidation here after 80. And what's 80? You know, it's like that's a 33% move here. We had a little tiny pullback, 1/3 of that. Then we shot up like a rocket, went all the way to 100, never got our pullback to 90 even, and went straight to 120. I mean, for God's sake, at some point you got to consolidate. All right, so this is, you know, and from 60 to 100 and to 120 is 60. That means 12 points is a weak retrace. So 12 points is 108. We're not even there yet. Another 12 points below 108 is down to 90 whatever, and that's there you go. In fact, that happens to be right there. That's the 50-day moving average is 95. That is a strong retrace. So this 50-day moving average, if we hit it, is not even bearish. It's just a normal consolidation. Probably when this 50-day moving average is at the 100 line, which will be like next month in January, right around earnings. So Apple should probably be down around 100 at earnings, and it's going to consolidate here. And then hopefully what's going to happen is when this line comes up and touches it, it's going to take off. And if we can time that right, if we're lucky, it'll time right into their earnings announcement. And if their earnings announcement is bullish, this thing will shoot up like a rocket and then blow through 120. That's what we're hoping will happen with Apple. Now, don't forget, we want to sell more puts when it gets down to 100. And here's the thing, though. Do you have the balls to do this? Because we want it to go to 100. I want to see that consolidation. I want to see it test the 50-day moving average. I want it to bounce up. When it gets to 100, I'm probably going to buy back some calls. As the calls we sold will be cheaper, so we buy some back, and we're going to want to sell those puts that we plan on selling. That's what we hope happens. If that doesn't go well and they just go up past 120, well, then we'll make all the money on that bull call spread. We have the 90-120 bull call spread. I would rather be able to sell the puts and increase the spread. I'll be very upset if all it does is go up and up, because that'll be annoying. And frankly, that's what's basically been happening to us year after year. Apple goes up and up and up and up, and we never get, we hardly ever get a good chance to double down or do anything about it. This year we did. We had a nice pullback here into 212. Look, Apple was our stock of the year. We picked it for a stock of the year here. We picked it for a stock of the year here. Here we didn't get a chance to increase our bet. Here we had a fabulous chance to double down and increase it, and we did. So this year we made much more money here. When Apple was our stock of the year here and we adjusted it and we stuck with it and we doubled down and pushed the bet, we made so much more money here than we did here, because here all it did was go up. That's not good for us. We made so much more money on the pullback because we got to buy more of it cheaper. All right. And let's see. Wayne says, do you think strong dollar will keep rising? I think the dollar is strong. No, nobody wants America out of all the countries, because we are a totally upside down country for import export. Like, we import much more than almost double what we export. We outsourced our manufacturing base to China years ago, so we don't manufacture anything, and we don't export much really. We mostly export services. So we actually benefit. We're one of the few countries that really benefits from having a strong currency. It makes the oil cheaper. It makes other stuff that we import cheaper. It makes our goods cheaper. It makes cars cheaper for consumers. And we don't give a crap about American cars anymore. It doesn't matter if we buy American cars or foreign cars. So it all works out basically for us to have a strong dollar. It's not, though, the government policy to have a strong dollar. Look, our policy is a low interest policy. That's the interest of the government is low interest, as we just talked about. That's what's important. A strong dollar helps because when you have a stronger dollar, then people are willing to accept a lower rate of interest because it's your currency they want. In other words, I'm a German and I want to tie up my euros. I want to buy a treasury bill in dollars because I know my euro is collapsing. And so I want to tie up my money into a 10-year T-bill in dollars. So I'm willing to buy those T-bills for dollars, convert my money, and I know I'm going to get dollars back, and I think the dollar has a better chance of holding up over the next 10 years than my euro does. In fact, the euro might collapse and be worth 10 cents. So I really don't want to keep too much of my money in euros. I don't think that's going to happen. I'm just saying, get out of fear of it. I do think the euro can drop another 20% easily. It's already down 20%. So, people are certainly panicking out of euros and obviously out of yen because the yen was a disaster. So where was I? So the dollar is strong because it's safer looking than almost any other currency on the planet, and that's fine with the government, with the Fed and all. It's fine with the government because we don't. First of all, let's just print as many as we want, and we're printing them. We don't print money to pay off our debts. We just print money to give to the banks. We print money to give it to the bankers, and they make profits. That's the scam that's running in this country. It'd be nice if we paid off our debts, but we don't. We just use the money to give it to rich people so they can make more money. And then we don't charge them taxes on the money they make, so it's completely useless to anybody but the rich people. So as to the strong dollar, yeah, we're going to probably continue to have a strong dollar because we have no reason not to, and it lets us keep printing money and paying off and funneling through the Fed. The Fed gets to buy treasury notes, and the bankers get to use the money, and they lend it out and make their own money, and everybody's happy except for the bottom 99% who get screwed. And all those debts, by the way, accrue to the bottom 99%. And as the Fed, when the Fed eventually, don't forget the Fed is the biggest single holder of all these outstanding T-bills and stuff is the Fed. And so if our T-bills start shooting up if our T-bills start going up in rate, then the old T-bills that are at lower rates become worth less, right? So if the Fed has $4 trillion of T-bills at 1.5% and rates go to 2.5%, then you multiply the 1% times the length of the bill. So let's say they're 5-year notes on the average. So basically, you would take the 1% times 5 years is 5%. So the Fed loses 5% of $4 trillion, which is $200 billion. And what happens to that $200 billion loss? That loss funnels to Treasury, becomes a negative on our current account deficit. So in other words, for that year, not only do the rates kick up on us, but we also lose $200 billion on the Fed, on their gambling. And that money then is charged back to the American people. Isn't that fun? The Fed can't lose. When the Fed makes a profit, Treasury books it as a profit, and they have been making a profit. All right, so the Fed has made a profit, and that's helped us reduce our overall deficit. But when it goes the other way, all the Fed losses become losses for our government, and they become government things that the people have to end up absorbing over time. So the whole thing's just a big joke. I can go on about this all day. It's a horrible, horrible thing. It's just a way to steal your money, basically. Yeah, Wayne, look, there's a case for a strong dollar going forward. We don't have a choice. We don't want a weak dollar because a weak dollar is going to drive up rates. It's rates. Everything is about rates, the fear of rates. When you owe $18 trillion, you better have a very, very, very healthy fear of rates. Because what happens if interest goes up to 5%? 5% of 18 trillion is $1 trillion. How could you owe and don't forget 5% historically is not much. Where's that thing? Oh, here. Historic interest rates. There we go. There you go. All right, so back to 1900, right? Where are we now? We're here, 1.5%. That's not normal. We owe $18 trillion. $18 trillion. I would have to call 4% more or less normal. And really, you got to say you can't count the 1900s. What's modern times? In modern times, and don't forget this is because Nixon removed the gold standard. This was on the gold standard. This was when a dollar was worth $1 of gold or silver, whatever. But the bottom line is it was worth metal. So back in these days, sure, you're backed by metal, so the currency is always going to be valuable, or as valuable as inflation is, right? That was then. Here's us going off the gold standard. Okay? And we shot up to there, and then we entered the era of federal policy manipulation, and they've been pushing and pushing and pushing and pushing it back down, but it's artificial. And while they've been doing that, we've been racking up $18 trillion of debt. So any return to anything like normal is going to be a freaking disaster. Because 4% of $18 trillion is a big number. I don't know. 1800 times 0.04. $720 billion a year just to service the debt. So if we had a zero deficit, we'd still be $720 billion a year in the hole just paying the debt. Now the reality is we got all the Social Securities and all the, all that other crap never went away. That we've got all these unfunded liabilities that are piling up. The baby boomers are aging. Blah blah blah. This is going to be a catastrophe. Okay, so just keep that in mind. At some point, it's going to be a catastrophe. I am leaving. My plan long term is to get the hell out of here and head over to Europe, because Europe will take it. Europe will actually end up better off than the U.S., but I don't want to be in euros. So I'm only 50, so I'm not worried about it yet. But about 10 years from now, it'll be time to get out of this country. Maybe sooner. I'm making the plans now. But about 10 years from now, it'll certainly be time to abandon ship on this place. Unless something spectacular happens. Oh, and by the way, the spectacular thing that could happen, the number one thing that could save everything is fusion. If they actually pull off fusion energy in the next 10 years or so, and we suddenly have a cheap, fairly unlimited source of energy, it's going to change so many of the equations that the global economy can start booming, really, really booming. Cheap, clean energy all over the world. That can like double the global economy and change everything, and all these debts won't matter, nothing will matter. It'll be like money well spent on these debts. So, who knows? Hopefully in the next 10 years or so, something will happen. Lockheed Martin says they're on track within 10 years to have the first commercial fusion reactor. So we'll see. So things like that, there's always those exogenous events that can really change the situation. But as it is now, with the economy we have now, the way we use oil, the way we burn fuels, the way we use commodities, we're in trouble. That's the bottom line. All right. I have Canadian dollars. How can I hedge that to the U.S. dollar? Let's see. Well, I mean, what's the real question? I mean, you want to make sure you don't lose value to U.S. dollars. If that's the case, I mean, you can just do a leverage play with up or something like that. Just to let it not get away from you. It just depends on why you're hedging and what you're trying to accomplish. If you're in chat, like, I'd rather talk about this like at night or on a weekend. It's a big topic. It's very complex, but it depends on why you want to hedge and what you're doing and so on and so forth. I mean, the Canadian dollars are down now because commodities are down, but when commodities come back, the Canadian dollars are going to be a great investment. In fact, I'm kind of like looking to invest in Canadian dollars because it's such a commodity-backed currency that you guys really benefit when oil prices come back, if they come back. But that won't happen soon. I'd first like to see a bigger collapse. Oh yeah, speaking of oil, how'd that go? 63.67, and it's 2:30, so this is right about the close for oil. So right about that 63.50 mark for oil as we expect. So you have too many Canadian dollars. It's really just a matter of diversifying. You can buy some American stocks, put your money in that. Buy some American dividend-paying stocks. I mean, the same energy trusts and things like that, the same real estate trusts, There's different ways you can put your money into American companies, put it in American dollars, convert your money, buy REITs and trusts with American dollars and have an American account set up. It's not that hard for you to do. And then you can just collect money. In fact, what you can do is you can set up a little, you have to talk to an accountant. I'm not an accountant, so, you can set up a U.S. corporation, and that U.S. corporation can then open up a trading account, and the trading account, the money will accrue to your U.S. corporation. There's all kinds of fun ways you can use that for write-offs and deductions, and you can change the money and so on and so forth. As long as you want to leave some money in dollars and let this company have, and then that company can pay you to be a consultant or whatever for doing it. There's all, you have to talk to an accountant who does this stuff. But if you don't have enough money, by the way, to set up a corporation and talk to an accountant and do all that thing, then don't worry about it. Worrying about money fluctuation is for people who have millions of dollars. If you don't have millions of dollars, and if it's not like a normal thing for you to pick up the phone and have your accountant form a corporation for you and set up an LLC and do this crap, then don't bother. Because it's not. That's what rich people do. I know it sounds great and you feel smart when you hedge your money with dollars and so on and so forth. But unless you got millions of them, don't worry about it. $100,000, $200,000, whether the currency goes up or down 5%, 10%, it's not going to make or break in. It's not worth the hassle of what you're going to go through to do it. But when you're millions of dollars, yes, absolutely, you should be doing it. So, like I said, let's talk and ship. You have millions of dollars, you should certainly be a premium member. We can talk and chat, and we can go over it. All right, but it's a big conversation. There's a lot of different things you can do, but it depends on your specifics and what you're really trying to accomplish. And yeah, Francisco, I know fusion's been 10 years away for the last 40 years, but I've never believed it for the last 40 years. I do believe it now. I'm really into this stuff. It's like I'm a big science guy. I love this stuff. And it really, they've been saying it for years. I've never believed it. Lockheed Martin put out a paper, and I really think they're onto it. I think they really are on that we're in that last mile. There may be some insurmountable thing that stops it from happening, like right at the end. You know how that is. You can build something for 5 years and then finally test it and go, oh, damn it, didn't do what we thought. But I think they're on track. Your mama says, given we're in a rate trap where all the industrial economies are overextended, do you think a coordinated offer by emerging markets to more competitive bond rates could essentially force us to bankrupt ourselves? No, because they're too small. Their relative size of the emerging markets means who the hell cares what they do, and also they can't afford it either. They're just as in debt as we are. It's not like they're not 100% of their GDP in debt. It doesn't matter that they're smaller. Put it this way: my daughter has no job. She's 12. Okay. So she's got no job. She'll get maybe $20 a week or so for her allowance or whatever. So her GDP is $1,000 a year. All right. So if she's $1,000 in debt, she can afford a 5%. Wait a minute. 5% is $50. So it's $5 a year. So if she's 5% in debt, she has to take of her $20 that she gets every week, of her $20 that she collects, she has to give me back $5 if she's $1,000 in debt. Okay, so she's small compared to me, because I could be $100,000 in debt, it wouldn't bother me. But my daughter, if she thought $100,000 in debt to her is like a mountain that can never be climbed. So I could be $100,000 in debt and just pay it off without thinking about it. She's $1,000 in debt, and she's 100% of her GDP in debt. I would have to be, say I had to be $1 million in debt to be 100% of my GDP in debt. It's the same thing. It doesn't look the same. It doesn't feel the same. Two people looking at it from the outside might think it's totally different, but to each of us, it's the same thing because each of us takes the same amount of money per week or per month to service it. You get that? So in other words, you can't look at it that way. You can't say, oh, well, how is it? There's nothing, there's nothing my daughter can do. So my daughter can go around offering 10% interest for her $1,000. And what does that do? How's that going to force me to go bankrupt? Because if you give her the $1,000, she's done. And meanwhile, she screwed herself because then now she has to pay back half her money every month, and she basically cut her allowance in half. Where's the benefit to her? And how does it hurt me? Because I'm borrowing. If I'm $1 million in debt, my monthly nut is $10,000. So it just takes 10% of 1 month of mine to fully fund her debt, and then what? So if you're a lender, you can give her, you can say, oh, I'm going to go all in on Jackie, on Phil's daughter. I'm going to go all in on her with $1,000. But she doesn't need it more than $1,000. You can't force more money to her. So consider her an emerging market. You pay her off, you get 10% of the high-risk asset, because it is high risk, because what happens if she doesn't get her allowance? What if she doesn't clean her room? Then you're screwed, right? Because she won't get her allowance, and you don't get your money. And then she'll have to start offering 20%. I mean, don't forget, Greece was offering 20%. That didn't wreck the global economy, because no one gave a shit. It's just Greece. All right, you got to look at it that way. You have to realize that, like, these are very insignificant amounts you're talking about when you're looking at these countries. They can't force anything. Russia even can't force anything. They talk about it, they can't. Russia's talking about going on the gold standard. Who cares? They can't buy enough gold to bother us. Okay, and it's Switzerland too. Switzerland was talking about going on the gold standard. Can't buy enough gold. Doesn't matter what Switzerland does. Okay, Switzerland's economy is the size of, like, you know, New York or New Jersey or something like that. It's not going to destabilize anything if they decide they want to buy a bunch of gold. All right, what matters is what we do and what Japan does and what the EU does. That's what matters. And to some extent, India, Australia, you know, it's a G8. If it's not a G8 country, it doesn't matter. And that is a mistake. A lot of traders make that mistake because you talk about, like, you want to watch this, you want to watch that. Don't go crazy. You gotta have a sense of proportion about these things. If it's not being done by a G8 country, it doesn't matter what's going on. I mean, it matters a little. You see danger signs and things like that, you shouldn't ignore it. But unless it starts becoming a thing unless there's a contagion where it starts spreading, and then it starts affecting bigger and bigger countries, like that was what happened in Europe. They were like dominoes, where one country went bad, another country went bad, Greece went bad, Spain, and then Spain, Portugal, and everybody's looking at Italy. And then if Italy goes bad, then what's going to happen the next? You know, that's when you start running into problems, because then you're touching G8 countries. So if a G20 country starts going bad and a couple of G20 countries starts going bad, then you got to worry about the G8. But right now, we're not even on the G50 for these kind of problems yet. All right, so we talked about that, and it is time to cut this thing out. So we have to see any trade on T or BZ right now. No, 3 or 4% does not really do it for me, but we'll take a quick look since we're closing out. Let's see. I mean, let's get a real sale. We got tons of things to buy. We have a huge buy list with tons of stuff on it. I mean, that's a nice drop. I like that in Verizon, but I'm not going to sit there. That's what you call a falling knife. I'm not going to sit there and jump on top of that. All right, so if they come down, they get interesting down here, and if the VIX was high, which it is getting higher, although it's not staying high, it's only at 1527 right now. So if the VIX got up to 20, and these guys came down to 42, and I could net in at 37, I'd be pretty damn interested. But we're a bit high right now. It's not like exciting, but with their dividend, it's nice. So I think it's a good choice and certainly worth watching. And if it goes any lower, I mean, for sure in chat, I'll be happy to talk about it. We can set up a trade. Oh, and T's good too. Look at T. See, 30 bucks is my buy price for T, so we're already down there. I'm pretty happy to buy T at 30. And I guess their dividend must be like 5% or something like that. I'm not going to look at it now. But if you look at AT&T, you could buy the stock for $32.50 because you want the dividend. You can sell the $30 calls. Don't be greedy. Sell the $30 calls. That's $3.50, let's say. So you're going to knock off. So that's $3.50. So now you're going to net in for $29. Then you say, okay, well, you know what? If they go to 25, I'd buy more. So now let's sell some 28 calls because that's going to net 25, right? So you sell the 28 calls for $275. So now you've knocked your net down to 29 minus 275. So let's say minus 3 would be 26. So 26.25. So if you do that, so you buy the stock, you sell the $30 calls and the $28 puts, and your net now is $26 and well, you know, about 26 bucks, 26.25, right? So that's 20% off the current price. That's your break even is now 20% off the current price. So you don't really care as much now if it drops a little further because you're buying in at this price. All right? But then, because it's T, you're still going to get your $1.84 dividend. And a $1.84 So 1.84 divided by 26.25, that makes it a 7% dividend you're collecting while you're waiting. And don't forget, you're going to call away at 30. So 30 is still a $4 profit, so you're still making like 15, 16% profit there. So you get 15, 16% profit if you call away at 30, which is $2 below the current price, and you get the 7% dividend. So it's essentially getting like 15% a year, or a little better than 15% a year for owning AT&T. That's great. Okay, do I love it? I don't love it because I think they should go. I think they all might go cheaper. I mean, when look, something drops 4% in a day is not really the day to buy it. So I do think they can get cheaper, but it starts to get very, very attractive here if you're a long-term investor. But long-term investor means that when it does drop to 25 bucks, you want to buy more, not you're going to run out and stop out of the trade. So if that's the case, don't even start buying here. Wait for a real sell-off. This is very attractive. This is where it does start getting attractive. As a long-term investor, I'm comfortable at the 25-30 range for the next 10 years. So I'm always happy to keep accumulating here and keep collecting my dividend for 10 years, and eventually I'll make my money. And if you tell me I can make 10 to 15% on a stock for 10 straight years, not worry about it, I don't think that's a bad thing. In fact, I think that it goes back to it. I think if it drops and it gets cheaper, I'll buy more. And if it gets cheaper, I'll buy more. And if it gets cheaper, I'll buy more because I want to own this thing. I want to own a utility company that makes 10%, 15% a year every year for 15 years. I love that. All right, so that's how we play this. All right, so I hope you learned something today. How's our indexes doing? We'll take one last look. Active trader. All right, so as we expected, we're pulling back a little bit off these highs, and what matters is where we finish. Are we going to finish above or below this 20? I told you I was going to test this line. Is it going to finish above or below 2050? Is it going to finish above or below? Forget the Russell, they're useless. You see this line? Remember I said we're going to draw this line down? And where are we? Right there, 17,750. So this whole pop and what's happened so far today, I don't attribute it to much. And what really matters overnight is what China does. That's what's going to matter tomorrow. All right. Well, thanks everybody for coming. I really appreciate it. And we shall do it again next week.